Okay, in the last video we talked about the special journals, and now what we're going to do is we're going to look at one of those special journals. This is the easiest one. It's called the sales journal. Okay, the sales journal we're just looking at are different credit transactions. When people buy something from us on credit, meaning they're buying it from us, but they're not paying us yet. We're going to invoice them. We're going to send them a bill later, and then they'll pay us back later. Okay, so they have credit with us. Okay, so here, right here, is an example of the sales journal. Now, I've already filled in some of the information that needs to be recorded in the sales journal, and then I have two transactions that I've already started. One is from Mark Oss. So Mark has come in and he's purchased something from us on credit, okay? Now, he's gonna owe us money. So let's say that he purchased a TV from us, and let's say that TV cost $1,000, okay? So I'm gonna put right here $1,000 because he's purchased it from us, okay? And let's say that it cost us $800. Okay, so we purchased it for $800. We sold it to Mark for $1,000. So we have a profit then of $200. Okay, so over here I'm going to put the $800. Now normally when we do journal entries, we would debit accounts receivable $1,000 and credit sales $1,000. Okay, for that credit sale. And then whenever we have a sale, we also have to recognize the cost of goods sold. That's the COGS, cost of goods sold. And then we reduce inventory. Inventory is an asset, so we reduce it by the credit. So we debit cost of goods sold, the expense, and credit inventory, the asset. Okay? So you can see here that this is a little bit simplified because we're not doing the debit credit journal entry. We're just putting the $1 amount in here for the debit to accounts receivable to credit to sales, debit cost of goods sold, credit inventory for $800. Okay? So there's our transaction. Now, let's say, oh, I didn't finish that. And then we would send them out a bill a little later, okay? So let's say the invoice number for that is 101, because we number our invoices so that we can track them, okay? Now, a couple days later, Susan Cho comes in, and she also is purchasing something from us on credit. She has an account with us, and we agree that this is fine. She can purchase from us. So let's say that she's purchasing a computer, and let's say that computer we sold to her for $800, and let's say we paid $500. So we have more profit here. We have actually $300 profit. Okay. So this is the entry, and then we would prepare another invoice for her, 102. Now, what happens typically with the sales journal is you're going to do all these sales. Now, I only have two here. Hopefully, there's lots more sales. Okay. Maybe there's lots of them on March 1st. Okay, and more on March 2nd and 3rd, 4th. Okay. So you'd have all of your transactions here. And then what happens is, at the end of the week or the end of the month, some time period, you're going to total these up. So in my simplified example, there's only two transactions, okay? But in your business, hopefully there'd be a lot more. We're going to total these up. And then what's going to happen is we're going to record these into their respective ledgers, okay? Now I put just a really simplified accounts receivable ledger here, okay? You would do this for every single account though. When I say every single account, I mean that the total now, the $1,800 has to go into the ledger, okay? So this $1,800 has to go into accounts receivable, but it also has to go into sales. Now, I'm not doing the sales ledger. I'm just doing, in my example, just the accounts receivable. So the $1,800, this would be the end of the month, let's say. So on March 31st, we go to our sales journal and we say, okay, this needs to go into the ledger so that we can track the accounts receivable, okay? So it's coming from, now look up here, S3, okay? This is where it's coming from. The posting reference, the PR stands for posting reference, so that we know where these numbers are coming from. Well, we're getting this number from S3. S stands for the sales journal. You could label it any way you want, just be simple. We're gonna do S for sales journal, and 3 means it's page 3. If it was S5, it would mean it's on the 5th page of the sales journal, okay? So anyway, I'm gonna put right here, S3, and this 1,800 is a debit, so I'm gonna put 1,800, and this is the only transaction, so the balance right now would be 1,800, okay? So then we would do the same thing for the sales journal. We would have the sales ledger. We'd go to the sales ledger, we put the $1,800 in there, it'd be coming from S3 and so forth, okay? Now, one more thing that I haven't done yet is, right here we need to say where this is going to. So if somebody's looking at this and they think, well, that $1,800 total, where's that going to? Well, it's going to the accounts receivable ledger, which is account 110. So you would put 110 right there, and then you put a slash because it's also going to go to the sales journal. Let's say the sales journal is 301. Well, then you have 301 because you're also putting that $1,800 into the sales journal. The same thing would happen over here. Here's our total right there. This $1,300 would go to the cost of goods sold ledger, but it would also go to the inventory ledger. So you put down those numbers as posting references saying where that number's going to, okay? This is kind of confusing, I realize. You've got to look at this several times in the chapter, maybe view this video several times to see how this actually works. Now, we have a posting reference here too. The reason for this posting reference is to say, did we put this into the subsidiary ledger? The subsidiary ledger is, there's one for Mark Oz, there's one for Susan Cho. We keep track of each of these people's, each of our customers' dollar amounts that they owe us, okay? So what would happen is, on 3/1, we would track, we would have a debit and credit, and we would track that Mark has $1,000 and a balance, so he owes us $1,000. There would be, remember this DR stands for debit. The PR says, where's this coming from? Well, it's coming from S3. So it's a credit sale, meaning that Mark Cho, and we probably put his name right here, I'm sorry, Mark Oz, so that we know that this is Mark's subsidiary ledger. We actually have a ledger, a sheet that's tracking how much he owes us, okay? And this came from S3. Now here, we just put a check mark. And that check mark means we posted it. We put it into Mark's account, okay? It's just telling us, yes, we posted this to Mark's account. This one doesn't have a check yet because we haven't put it in Susan Cho's account, okay? But Susan Cho would also have a subsidiary ledger, and when we do put this $800 into Susan Cho's, then we put a check mark saying, yes, we posted it there, okay? Once again, lots of good information. You need to understand what these subsidiaries are, the purpose of them, how you record transactions, and then what you do with totals, how you put them into their ledger accounts, and then also the subsidiary ledgers, okay? We're gonna go over some more subsidiary ledgers and some more special journals in the next videos. Good luck.